So this week we're talking about simple car financing. We want to buy a car, we go to a dealership and we pick the car and then they give us some choices as to how we're going to pay for this. So there are two types of interest rates that we could be offered. The first one is a variable interest rate, which the interest rate may change for the duration of the loan, which may be risky because the interest rate could actually go up, especially nowadays when the interest rates are really low. Having a variable interest rate would probably expose us to an additional risk. A fixed interest rate, well, this simply means that the interest rate is constant for the duration of the loan. However, if you're expecting the interest rates to go down, then variable interest rate may also be of interest. But generally, a fixed interest rate, you at least know what your cost is going to be, what your monthly payments are going to be, and there are no surprises. What you see is what you get. With a variable interest rate, you really don't know how the interest rate is going to change. It may change in favor of you or against you, and there may be some bad surprises. Typical lengths for car loans are, most common is a 72 months, 6 years, 7 years, but usually it's 5 years plus. Because interest rates are really low nowadays, I think that the most common for the past couple of years have been towards the 6 years. But traditionally, car loans are about 5 years. If you're buying an RV, then you're talking about 10 years. Um, but the car loans are 5, 6, or 7 years. So, what is an amortization? Well, keep in mind that when you actually buy a car and you have a loan, um, you will actually have a payment on a monthly basis or a periodic basis, and you should really read the fine print before you sign the loan documents. So, with respect to the amortization, if I were to go to a spreadsheet just to show you how the loan interest rate is actually calculated. So let's say that you actually have a $10,000 of a loan and you are paying 1% a year. Well, let's make it more realistic. Let's say that you're going to be paying 5% a year and per annum, right? Which simply means that the first year, what you're going to pay is going to be the entire principals, or the interest will be based on the entire principal, which simply means that you're going to be paying $500. So this is your first year's payment. Now, obviously, you're going to be paying this on a monthly basis, and you also like to pay some of the principal. So your monthly payment will not be just $500 divided by 12, but it will be $500 just the interest, and then and then you want to pay some of the principal down as well. So what happens then is if you actually end up paying some of that principal down through your monthly payments, the next year you will probably have left, say, $9,000 of your overall balance. Your interest rate, if it is fixed, won't change, but because you have left $9,000 or less, depending on how much of a principal that you actually end up paying, you will pay less interest, right? So your interest on the loan is calculated on the outstanding balance. And each monthly payment that you make has, so let's say that you're making about 700, well, let's say that you're making about $250 of a monthly payment. Well, some of this actually goes towards the paying down the principal, and then some of this goes to paying the actual interest. So at the beginning of the loan, your monthly payments are mostly interest. In fact, we're going to talk about mortgage more, with the longer terms, like a 30-year mortgage, this is a lot more visible. Almost like your first payment is almost entirely just interest. Um, Same thing with the car. Obviously, we don't have as much of a time period. You only are talking about 5 or 6 years, or about 72 months. So 72 payments. So the first few payments will be almost entirely interest. And then towards the end of the loan, you will have a very little outstanding balance left. Therefore, the interest on that balance will be very small. So when you actually write a check for your last payment of 250 or whatever the monthly that you're going to pay, most of it will be towards the principal and you will have very little interest left. So from a lender perspective, um, they really want you to pay interest. That's how they make money, and therefore, as you have more balance at the beginning of the loan, you end up paying a lot of interest at the beginning. Even if you decide that you're going to pay it down, you're going to sell your car, and then let's say that you draw your car for a couple of years and you decide to sell it. Well, then you've actually paid a lot of that 2 years towards your interest rather than the actual equity of the car. So it is the natural, or how the car loans work. We make periodic payments towards the car, towards the loan. Most commonly, you will make a monthly payment. You could request a bi-weekly payment. It's really not that common, and most people will give you a stare on the face, but you can. But most commonly, you're gonna have to make a monthly payment. Even though you're required to make that monthly payment, it may be beneficial if you actually pay that required monthly and then make a voluntary weekly payment. Now, remember, what you are paying every month will be a little bit of the principal and then the interest, and interest accrues, but interest accrues on the outstanding balance. So if you could actually pay that balance down as soon as you can, the amount of interest that you pay will go down as well. In fact, after you make a substantial voluntary payments, you could reach out to your lender and request a reduction of your monthly payments that you are making, because now you have a lot less of a outstanding loan balance. So some lenders may allow you to early pay. So I've been talking about these voluntary weekly payments. Not every lender will let you. Some basically will just say, look, you borrowed money from us. It is what it is. It is 5 years, and then we expect you to honor that 5 years. You can't pay it early. Some will allow you free and clear. They basically say, look, if you want to pay it early, you pay it early. But then some may require you to pay a penalty. So just because you can make an early payment doesn't mean that you are able or you're allowed to make an early payment. So it is really advisable that while you're signing your loan documents, you should check to confirm that you could pay it early, you could get out of it if you have any money, and that there is no binding time frame for the loan. And if you wanted to get out of it, buy yourself out, you should be able to buy yourself out. But then again, not every lender will allow that to happen. And then there may be some, penalties. I remember a friend a few years back wanted to get out, and they actually had about $2,000 penalty just because he wanted to pay it down early. So there may be some penalties that you may have to pay. But in my experience, most reputable lenders nowadays will allow early payment, closure of the loan, or paying it down, paying it lower. However, you really have to check, and you should not assume anything about the loan that you're about to sign. Um, some loans, by the way, they can be sold to third parties. So you actually think that you have, ABC Bank, and then a few months later, you receive a letter that the loan has been sold, and now you're with DEF lender. Um, under normal circumstances, the conditions of the loan should not change, and it's just whoever is facilitating the loan, it just changed, and it can happen, and it does happen quite a bit. Um, so the car loans require you to have an insurance. From the lender perspective, think about it. They're giving you money to buy a car, and the only collateral that they have is the car. I mean, obviously, they depend on your credit history, the credit score, and all of that. But ultimately, it is the car, the collateral, that is getting you that beautiful, favorable interest rate that you wouldn't otherwise get. Remember, when you have a credit card, which solely depends on your credit score and credit history, you're talking about interest rates of 24, 25% a year. When you're getting a car loan, you're getting a really favorable interest rate, like 4 or 5% nowadays, which simply means that there has to be some sort of a collateral that the lenders are basing that low interest rate on. Because the car is the collateral, the lenders will require you to have excessive amount of insurance, and you can't blame them for this. Liability is law. I mean, you're required to have a liability insurance. But then insurance companies, well, lenders, uh, car loan lenders will require to have a full coverage against theft, collusion, all sorts of, full coverage above and beyond the value of the car. But obviously, it's your right to have a deductible, but be very careful with it. Deductible is exactly what it is. If you ask for a high deductible, um, you will have a lower premium to pay. However, you will have a higher deductible. That's an out-of-pocket cost. So if you have a collusion, say for instance, and you have a $2,000 deductible, well, if the collision costs you $5,000 to fix, well, the $2,000 will be coming out of your pocket. So be careful with the deductible. If you go with no deductible, then the premium will be very high. But if you go with a very high deductible, the premium will be low, but then you will have a lot of out of money cost. There's something called a gap insurance. The loan lenders may not require this. However, in my own experience, I find them to be very useful, and you should know what it is. So a gap insurance works like this. The traditional full coverage insurance, even if you're paying excessive amount of money, you're thinking you're fully insured, you really are not. So what happens is this, especially if you're buying a brand new car, the value of the car depreciates immediately as you drive off the lot. So, and people say that it's about 20% the first day. Um, and that's terrifying, because if you buy a car, say $20,000, and you park on the street, and then the first night or the first week, first month, your car gets stolen. So what will happen is your insurance will pay the value of the car. They will have a blue book value, and then they will pay the value of the car. Um, Now, again, for brand new cars, 1 year old, 2 years old, 3 years old, this will be more of an issue, because you're going to have a value that depreciates a lot faster than how much loan you're paying down. Remember, when you pay the loan, the first couple of years, you really are paying just interest. You're not paying down the loan all that much. So what you owe on the car stays pretty much similar to what you initially borrowed for the first couple of years. So, but the value of the car goes down significantly first couple of years. So, if your car gets totaled or stolen first year, your insurance company will say, "Okay, we'll pay you $15,000. That's the value of the car." So you receive a check for $15,000. And then your loan says, well, there is no car. Now you have to pay it, to pay the whole thing. There is no car anymore. They're going to call the loan. And then you have a $20,000 or $19,000, because remember, all you have been paying is the interest for the first couple of years, right? So you will have a significantly more than the value of the car as an outstanding loan debt. So insurance pays you at 15, and then you actually owe the lender $20,000 or $19,000, and you can see there's a gap, right? So you can actually get a gap insurance. This is an additional insurance, and a lot of the times lenders will not require you this, but it is a very good idea to consider because the premium for this may not be much. In my own experience, for instance, I used to pay $5 or $10 a month in addition just for the gap insurance, and obviously it depends on the insurer. It depends on your credit risk, but this is primarily depends on how much of a gap you could have. The more expensive the car, cheaper it is. I mean, more expensive it is, and so on and so forth. In my case, it was a Toyota Corolla, so the gap was not as big as it would have been with some foreign cars. Um, but this gap insurance is a significant deal. A lot of people actually do not realize that if you are buying a car and you're buying it through a loan, anything happens to the car, a lot of people believe that insurance will pay the loan and you'll be off. That's not the case. Loan and the car are actually separate, and the car is the collateral for the loan, yes, but they are separate. So anything happens to the car, you get money from the insurance, but it may not be enough to cover the loan, and you may have to pay it out of pocket. So it is really, really important that you consider the gap insurance. And then finally, we have these popular car leasing, and this is really nice. You drive a new car every few years, but you should know that car leasing is actually designed for companies and not individuals. Although a lot of individuals actually take advantage of this, and like I said, every few years you drive a brand new car, and it feels really nice. But you should know that car leasing is definitely not buying a car. So when you lease a car, you're not buying it. It is very similar to a long-term renting. It's like you go to Hertz or Enterprise and you rent a car for 2 days. With leasing, think of it like you're renting it for 2 years. It's somebody else's car. It's a rental car, pretty much, right? Almost. Um, Car leasing can be quite expensive and binding. If you actually look at all those um, TV commercials, it says there are upfront fees that you have to pay, some registration fees that you have to pay, and then it's up to a certain years, like 2 years, 3 years, and then you will have mileage limitations. 10,000 miles a year or 12,000 miles a year. And there are a lot of problems with this. Just when I was preparing these notes, I got curious and I Googled it. And what I saw was a lot of people have a car, driven it for 2.5 years, and now the mile is at the maximum. And if they were to start driving it anymore, um, or they were to continue driving it anymore, they would have to pay mileage fees, additional mileage fees. Remember, this is a rental car. So these hidden fees could be quite expensive. So car leasing may have upfront fees, and obviously they have monthly payments. But because of these monthly payments, people feel that these are like you're buying a car and this is a loan. It really is not a loan. You're not buying the car. This is rental. There could be per mile charges. You probably are not allowed to return early. And if you insist, I'm sure that there will be significant fees to pay. And then there are unload fees, among other hidden fees. You should read the fine print. And at the end, when you're returning the car, they may give you a choice. You return the car, or you could just buy the car with the residual value. But again, you should be careful with it. In my own experience, that residual value has never been fair on the consumer. So I'm thinking 2-year-old car should not be that expensive, but it is what it is. So car leasing may have a mileage limitations among many other limitations, so you should be very careful with it. I've heard car leasing situations where you cannot drive long distance, like you couldn't leave the state and that sort of thing. So you should be careful with these limitations when, if you are considering a car leasing, you should know again, car leasing is not buying a car. Um, like I said, it's nice you're driving a new car every 2 years or every 3 years, but it can be very expensive, and you should know you're not buying a car. I can't just say this enough. So we talked about simple car financing. There are variable interest rates or fixed interest rates. They are usually 5 years plus, or 6 or 7 years are very common. Um, at the beginning of the loan, you actually pay pretty much interest and not the principal. And then towards the end, you actually end up paying the principal down. It's very common to pay monthly payments, although you could actually pay it more frequently. Not every lender would allow you to pay it down early. So you should check if you could. And if you can, I think that it would be nice to pay it a little bit earlier, just so that you actually are paying down the actual principal rather than paying just interest. And after you make enough payments, you should contact the lender and ask them to recalculate your payments. And I can assure you that after making those payments, you will have a different payment schedule for the remainder of the loan. But again, you have to make sure that the lender allows you to make early payments and that there are no penalties to make a payment. Uh, Again, you would be surprised. You send a $100 an additional payment. You're thinking, what a responsible person I am. I'm paying down my loan. And then they send you a bill and they say, well, there is no early payment on your car loan. And well, there's a penalty. We deducted $100, but here's a $350 penalty that you need to pay now. And that can happen. So be very careful to make sure that when you're signing the loan for the first time, you know what you're getting into. There are excessive amount of insurance requirements for good reason, and but you should know that just because you have full coverage, you really don't have full coverage. There's always a gap, and then gap insurance is something that everybody should actually consider. It could be expensive, but in my own opinion, it may be quite worth it. And then finally, you should know that car leasing is not buying a car, and there could be significant costs associated with leased car and responsibilities, and then it could be expensive and binding. And that's about it. So if you have any questions, please let me know, and thank you for watching.